and let's move to the euro dollar, which I know lots of people trade. And why don't we cycle through the charts on the euro dollar here and see what the business is going on. Look at this. This is an example of divergence. Aren't you glad that we switched over to the euro dollar? We're down on a 15-minute chart. And earlier today, the currency pair was making a higher high on price, but a lower high on the MACD. And lo and behold, the currency pair fell through the 62, fell all the way down to the 200 and the 800 simple moving averages. And that is an example of divergence. Warren asks, Rob, are the MACD settings aimed at speeding up or slowing the signals? Definitely aimed at slowing the signals. You have a brilliant question, a sharp mind. I want to give you the sharpest mind of the group award today and just ask everybody if they will give you a round of applause. Too bad we can't make any sounds here. Chris, I don't know if I got these numbers correct, but it looks to me like the 1 hour euro dollar has been away from the 800 for quite some time. I don't know, Chris, if you agree with that or not, but that's what I'm thinking. In a Bloomberg poll, the general consensus is the MACD is the most reliable. Wow. Check that out. So it's I don't know if I got the numbers exactly right. It's over 1,000 candles though. This currency pair has been away from the 800 simple moving average for a long time. And profit, yes, it is based on backtesting. Every word that comes out of my mouth with regards to stuff that I do is based on backtesting. Absolutely, yes. Look at the dollar, and we'll take a look at this divergence. See, on the 1 hour chart recently, the currency pair made a lower low on price. But meanwhile, on the MACD, it made a higher low. So when the currency pair crossed above the 62 exponential moving average, it was an early warning sign that the currency pair would probably move all the way to the 200 or all the way up to the 800 simple moving average. Bye. And that's pretty much awesome. I leave the MACD settings 30, 65, and 23. When I use it, I leave it on that setting all the time on every currency pair and on every time frame. I don't change the 30, 65, and 23 according to time frame, ever. Because I'm not trying to approximate one chart's view onto another chart. I'm trying to see each chart as its own separate blah, 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 whatever I just said. Okay. The euro dollar then popped up above the 1 hour 62 and the 1 hour 200 simple moving average. It is absolutely extraordinarily common for it, once it has done that, to fall back down immediately and take a really quick turn back down to the 62 and the 200 simple moving average. And once it does that, it typically also can make bounce back upwards all over again. So let's talk a minute, just 1 minute, 60 seconds, no longer, 120 half seconds. Let's go down to some other time frames and let's take a look at what we would do. Could we buy the currency pair on a bounce back up? Could we sell the currency pair if something else goes wrong? What shall we do? Let's look at the 5-minute chart and see if we see anything interesting. Well, in the 5-minute chart, the currency pair looks like it wants to fall and hit the 800 simple moving average, which is this dashed black line at the bottom. Checketh that out. The currency pair not only is falling towards it, but it's doing a fairly good job of that. If the currency pair falls below, and this is a short-term scalping type trade, 36.84, I'm going to guess that it's going to fall 20 pips all the way to the 800 simple moving average. Now, there's no guarantee that that currency pair is going to fall and hit that 800 simple moving average just yet. In fact, sometimes the currency pair will fake us all out by falling towards the 800 simple moving average and not turning around, and not going all the way there, but turning around and going back up the other way. It's a cheater and a false thing and a whatever. It's like Joe Lieberman switching parties, or whatever he did. It is a turncoat, and you can always tell that that's going to happen by seeing the currency pair turn around and rise above the 62 exponential moving average. That's red, and if it does that, that means, in my opinion, that this currency pair is going to turn around, go back up, and probably not only hit the 200 simple moving average, but go much further than that. So, Let's go back to the 1 hour chart and talk about this once more because I've said a lot of things and I'm not put them in order and you're probably confused and I've probably just made this the last webinar with me that you'll ever attend. The currency pair on the 1 hour chart has just gone above the 62 and the 200 simple moving average on the divergence trade, and it is now coming back down and retesting the 62 and the 200 simple moving average. That's super common. It happens all the time. Happens on Valentine's and Groundhog Times and all kinds of other times. And it usually then pops back up a bit. If not a lot, it pops up a bit. And if it's not going to resume the downward trend, it's going to pop back upwards. And it could pop back upwards so far that it reaches the previous highs that the currency pair made when it pops back up above the 62 and the 200 simple moving average. But how are we going to structure a trade? How are we going to do that? How would we know? How would we get into something like that? It sounds delicious. So if it sounds as delicious to you as it sounds to me, I would wait until the currency pair goes above the 62 exponential moving average, closes above that level. A candle closing above that level means that a candle body is white or the color of a bullish candle on your chart, and part of the candle body has closed and finished above the 62 exponential moving average. If it does that, then that's a buy trade for me. A stop loss can get moved to break even. That's an awesome thing. When the currency pair gets to the 200 simple moving average, it's simply a place that we can manage our risk and reduce the risk associated with being in the trade in the first place, and then we can get up all the way possibly to the previous high up at 37.80, and that makes us happy. However, if the currency pair falls and goes down below this previous low, it's probably going to hit the 800 simple moving average, and that could be a short-term scalping trade back down to the 800 simple moving average. My 62 exponential moving average is exponential. It's exponential because it's exponential. One time my daughter peed on the floor of the bathroom, and I said, Peanut, why did you do that? And she said, I peed on the floor because I peed on the floor. And the answer is it's a 62 exponential moving average because it's a 62 exponential moving average. And that's what we tested. We just liked how that worked better than anything else that we used.